Now, back to your friends, Don and Gino.
That's right, we are your friends, but today it's not Don and Gino, it's Dan and Gino. Pretty close, we're only one letter different, man.
1A.
1A. Not AAA, not 1A, but actually MLB. Tell me a little bit about the Dodgers.
Dodgers, they're taking it to the Twins. They're up 8-4 now, and they're still in the top of the 7th. So about 6 more outs, and they'll wrap it up.
Oh,
9 more outs, I guess.
That's
Yeah,
pretty
9.
good. So, in fact, hopefully they can put another couple numbers on the board there. Now, at this point, it's just for the baseball cards, right?
Right. Exactly. All the stats.
Yep. So today joining us is PJ Harrigan with Radian Guarantee and Dan Hunt with Cherry Creek Mortgage. And what we're discussing is mortgage insurance. And up until now, we've had a discussion about globally what mortgage insurance is and who it can affect and who it protects and things of that nature. And for the next 2 segments, what I really want to get into now is how can we benefit from it? How do we use it? How do Dan and I use it every day at Cherry Creek Mortgage as a tool to help borrowers make more money? And there's a few ways we do that. So the first thing I'd like to talk about, you've kind of alluded to it a little bit, was the availability to get into the market sooner. We've talked about that with the smaller down payment. So I wanted to give some really, really rough numbers. If you purchased a $400,000 house here in Santa Clarita last year, you would have paid, if you utilized monthly mortgage insurance, you would have paid approximately, if you did 5% down, very rough number, say about $300 a month in mortgage insurance. Sounds like a lot of money, right? It's a car payment. But ultimately, that $300 a month is only $3,600 a year. If that same $400,000 house that you purchased last year, if it appreciated at the average that Santa Clarita market appreciated at 25%, it was $100,000 in appreciation for a $3,600 cost. So at
That's
that point,
not bad.
That's pretty good.
yeah.
That's
So I'll
pretty
let
good
you
return on
guys
your
take
money.
over there. I think I made my point with how valuable mortgage insurance can be. So let's get into some of the details. I mean, there's multiple ways to utilize it. So tell us a little bit about it.
Well, first of all, at the highest level, you have borrower paid MI and you have lender paid MI. And it's just that. With borrower paid, the borrower pays for it. And with lender paid, it's embedded in your loan, and they get to take advantage of the secondary market income that they get to help offset the cost of it. There's pluses and minuses of both those programs. And then within borrower paid, you have a couple of different options. You have the borrower paid monthly we talked about. We have a product we call the split edge product, which is a hybrid, very similar to FHA. So you've got upfront and monthly. And then you have your upfront, the single, which can be paid in cash or can be financed. Each of those products have their pluses and minuses, and we actually have a tool on our website that you can use as loan originators to go in and do a comparison side by side by the products based on your consumer, your borrower's needs, to show them which is the best product for you. And it gives you, here's what your price is going to be, on a monthly basis. This is what your upfront cost is going to be. This is what your cost is going to be after 10 years. It can help you do some break even. So it's a great tool that you can use on our website. So
that actually brings me to a point, Dan, and I'm sure you'll agree with this, is that in our industry, unfortunately, and listen, if you're not paying attention or you weren't paying attention, listen to this because it's probably the most important part of our show today. You have options, okay? If you're talking about mortgage insurance to your lender and he didn't give you 3 or 4 different options, or he didn't ask you he or she didn't ask you what your goals are, didn't ask you what your timeline in the home is, run and call us at 855-DON-GINO, 855-DONGINO.
I think the flexibility and the options is so key, especially in the environment that we're in today, because everybody has just different needs. I'm going to be in my house 2 years, I'm going to be in my house 15 years. I have a bunch of cash that I'm going to be able to use, or I don't have a lot of cash. Those are all things that come into play and that you can best counsel them on what are my options and where do I go? Because like lender paid. Lender paid is good for some consumers. It's not good for some consumers. Borrower paid monthly is good for some consumers. It's not good for some consumers. But if say you have a borrower who has a big chunk of cash, you more or less buy out the MI by doing the single up front. Or say they're going to put that money down, they have at least 10% down, maybe they finance it into the loan if you guys allow that. There's so many options that can help them meet their financial goals.
Right.
So, Dan, what's your favorite tool? Because, what's interesting about this is your mortgage planner should be strategizing with you on what's best for you. And Dan and I may not even have the favorite strategy. Our strategies may differ, right? It depends.
Yeah,
So
I mean, there's a ton of things you can do, and you can go to we go to their website. We just plug in a few numbers, and it spits out all sorts of different options, which we then use our mortgage coach, is what we call it.
That's
our,
right.
Breakdown system. Plug it in there, and each borrower gets 3-4 options of what they can do.
Yeah, so in fact, what Dan's alluding to is Mortgage Coach. And Mortgage Coach is one of our unique advantages here at Cherry Creek Mortgage, that we make sure that everybody gets a detailed analysis. What it does is similar to your website, PJ, is it allows us to compare 4 products side by side. And it allows us to change the timeline on those products and look at the total cost analysis. That's something that not a lot of lenders do, is to look at the total cost 2 years, 5 years, 10 years, 30 years out, because and this is kind of one of my catchphrases, is the lowest interest rate on the wrong program will end up costing you money.
Oh, exactly right. And lender paid, again, is another good example of that. You can take a little bit of a hit in your interest rate, but the overall payment and your long-term costs can be much lower.
Yeah.
Well, another good example of that is FHA versus private MI. And I'm probably jumping ahead a little bit here, but FHA tends to have a better interest rate today than a conventional loan. But because of the cost structure of FHA, you're actually better going with a 5% down conventional loan, because the bottom line to the consumer, it's much more cost effective.
You've opened up a can of worms there, PJ, and that's PJ Harrigan with Radian Guarantee. And I'll tell you that we're going to spend a lot of the next segment on that piece, because it's so critical, the relationship between FHA and conventional. In fact, let's go ahead and get into some of that right now. We have a few more minutes left, so let's get into some of the basics. So FHA is a federally guaranteed insurance. What it actually is a mortgage insurance company financed by the taxpayer.
Exactly right.
So ultimately, when a lender, okay, any of the large lenders, any lender gives you a mortgage that's FHA financed, they're guaranteed by the government that you're going to perform, because they built the guidelines. And if you don't perform, they have a resource to get, I believe it's 25% coverage that the FHA gives the bank. So they get a 25% coverage on that particular loan. So if you default, we, the taxpayers, are all financing FHA defaults.
And most people don't think of FHA MIP as insurance, but you nailed it. They are an insurance company, because that's what they're doing. And it is backed by the government, whereas private mortgage insurance is just that. It uses private capital to insure those loans.
Boy, I said you opened a can of worms, and here I go. The reality is that private mortgage insurance companies are run more efficiently than government than government-run insurance companies. Hence, and therefore, private mortgage insurance is cheaper than government mortgage insurance.
Much cheaper. FHA is 1.75 up front.
Yep.
And
which means they add that they take your loan amount, multiply 1.7%, and add that straight on top of your loan amount.
So your net LTV is much higher than what you are thinking that you're getting, so your equity is eroded from day one. Then,
on top of that,
on a 30-year fixed rate loan with an LTV above 90, which most FHAs are done at 96.5, it's going to be 1.35 per month for the life of the loan. You can't get rid of it.
Right.
And if it's above 625, which may be the case here, I believe it's another 5 or 10 basis points on top of that, correct?
Yeah, there's actually a premium for when you go into the larger loan amounts.
5 basis points?
I believe there's a 5 and there's a 10. We don't, it's funny, we don't utilize too much FHA lending between 417 and 625, because typically those folks have the resources to put 10% down. And then at that point, we either utilize mortgage insurance, or we even have the ability to utilize the first and second combo.
That's a 4-letter word in my house.
Right? So PJ Harrigan says first and second combo, no good.
Well, it would kind of just a personal story is I'm in a loan right now. I have about a 70% LTV, but I want to get it down to 417. We're doing a first and second combo to get my first into a 30-year fixed rate Fannie Freddie loan.
Yep.
So it's a good strategy. It's all about flexibility, and options for the consumer. So if MI is not the best option,
And the thing about FHA, which you hit on briefly, is it's for life these
it is
days.
for life.
You cannot get rid of it unless you refinance the loan.
Yeah, actually, Dan, thanks for reminding us. And that's Dan Hunt with Cherry Creek Mortgage joining me today in lieu of Don Getling, who's out taking a well-deserved vacation. He and Cindy are out in Chicago having a good time. Have a drink for me or two, which I'm sure you'll do. And what you guys were just discussing was life of the loan mortgage insurance. So that's something I definitely want to dive into.
Well, kind of an interesting topic right now because for the most part, borrower paid monthly has always been refundable. And that means that the borrower, if they sell or refinance, can get I mean, that's not really the best example of how to do it.
No, but
because
that's a fair example. Unfortunately, it's just a few bucks.
Exactly. You don't get very much back.
Sounds good, though.
But with a singles have historically been non-refundable.
Right.
With some changes in the regulatory environment, we have come out with a refundable. There's some question over the appropriate refundability period, 5 years, 3 years, versus until the loan amortizes to 78%. But you can recapture a portion of that up front with a refundable product. Versus, then there's another portion of that is the ability to drop it, which is probably more the pertinent avenue to go down.
Yeah, in fact, that's what I think we should spend the next segment on. I'm really quickly going to touch on that life of loan thing that we were discussing. In the past, FHA was a great strategy instead of private mortgage insurance. One, because it was more flexible during the downturn and as far as credit and things of that nature. But number two, it used to be temporary mortgage insurance. That life of loan mortgage insurance will be very expensive in the long run.
Hugely expensive.
Yeah.
You can only, if your LTV is less than 90% on an FHA loan, you can get rid of it at 11 years. Or if you do a 15-year, and there's some other correct there.
Yeah. So when we get back, we're going to discuss the number one question I get about mortgage insurance every day. How do I get rid of it? On the Don Gino Real Estate and Finance Show.